All
All right. Welcome, everybody. This is a webinar about real estate development. I am Michael Huseby. I'm a lawyer at a law firm called TIL, and we set up real estate funds and syndications and other things that have to do with real estate development. That's me. I'll pass it off to, I don't know, John, because you're going to talk after me anyways.
Sure. My name is John DIPASQUALE. I'm a transactional real estate lawyer with a national practice. I run my own firm, JD3 Law LLC. I partner with Michael and his team at TIL on real estate deals moving forward, and I'm going to talk about JVs today.
Right.
And I'll pass it to Antonia.
Thank you, John. I'm Antonia Botero, and I have a development management and a real estate development company. Our development management company does work all across the country. We do all kinds of hospitality, multifamily, and resort master plan communities. We build those for other people. And then we have, along with Adrian, we have a real estate development company that only does condos in New York, and Michael has helped us set up our fund, and that's why we are here today.
I like the Mad Project product placement, by the way. That's
There
very
we go.
good. Yeah, that's good. I
Yes,
just noticed
Very
that.
good. Yeah.
Mad Project.
Good job. Yeah. My name's Adrian Guenther. I am Antonia's partner in our development company, which, like she said, is focused on high-end luxury condo product in Manhattan.
All righty. So now let's just get right into it. We're gonna basically explain how real estate development works and how you can set up deals and things like that. So the first thing that we'll talk about is a common question we get anyways, is like, how should you structure this thing? Like maybe you have some people who want to invest. How should you do it? And so I'm going to share my screen real quick. Can you guys see it? I didn't blow anything up, did I? Okay, cool. So what I'm going to talk about is funds versus syndications briefly, and then John's going to hop in and talk about JVs, which are kind of a different beast. So with both funds and syndications, you're pooling money from a bunch of investors. So it's not like you and another guy or another woman. It's like you and like 10 or 20 or 100 other people. And those 100 other people are typically passive, and that's going to be a little bit different than what John's going to talk about. But the difference between a fund and a syndication is basically how many assets do you have in the vehicle. So a lot of people start out doing what are called syndications. This is, you just put one asset in the vehicle. So you develop one condo project, you buy one strip mall, you do one thing. And the other one, the other option is a fund. And in that, you basically create a vehicle to go out and buy a bunch of stuff. So, like 10 multifamily buildings or something like that. So people often are like, well, what do we do? Which one's better? And so we have here just kind of some costs and benefits of each. So setting up one syndication is generally easier and faster than setting up a fund. So that's good for syndications. But once you actually have the fund set up, it's basically faster to use, because instead of going out and having to talk to a lawyer and raising capital or something like that, you have the fund, the capital is ready to deploy. Kind of to that same point, you're always fundraising if you do SPVs. It's like you have a deal, another fundraise, you're always fundraising. If you have a fund, you do have to fundraise a bunch at the beginning, but then you kind of have a war chest to go out and do deals. It's much faster to deploy capital once you actually have the fund. Same basic premise that we just discussed, because you already have the capital, it's committed. As far as management, once you have like 2 or 3 or 4 SPVs, you start having a lot of entities out there. A lot of stuff with Delaware, a lot of QuickBooks instances, a lot of tax returns. So having a fund is kind of nicer in that respect because you have less things to manage. Sometimes it's easier to raise money for syndications than funds. And the reason is investors like to see, look, here's a thing, here's like a building, and I can look at the building and there's pictures and it's very pretty. And I can, if I'm, somewhat sophisticated, I can, look at the pro forma and see whether I think it's any good. And so investors like that. With a fund, it's called a blind pooled account. It's kind of, trust me, like I'm good at investing. so just give me some money and I'll do some investments. And so after, that certainly can be successful for sure. And we have lots of clients where that's done successfully. But when you're starting out, sometimes it's easier to raise money deal by deal. And then this is kind of an esoteric point, and we'll actually hit it in a minute. But in funds, the waterfall, the distributions are typically netted. And so what that means is, let's say you do 5 deals and like 2 are trash and 3 are pretty good. You're going to have to return the money they invested in all deals before you start taking carried interest. So if you had like 2 total losses, you're still going to have to return that capital, as well as the capital you took to make the 3 good deals. And so the result is the amount of carried interest or promote or whatever you want to call it that you might earn might be less. On the other hand, if you do SPVs, everything's segregated. So if you have 2 bad deals, that's not good, but it's not going to affect your ability to earn carried interest on the good deals. And so that is one reason why some people like doing deal by deal instead of a fund. And so again, these are all instances where the investors don't really have many rights. Like the GP runs the show and the LPs are along for the ride. And so to kind of contrast that a little bit, I'll throw it over to John, who's going to talk about JVs, which are kind of a different structure.
Yeah, thank you, Michael. And that's right. When a client comes to me and they say, hey, John, we want to set up this JV, the first thing I always say is, well, what do you mean by that? Because the JV can take a lot of different forms and look very differently depending on what the partners want to do. Sometimes the JV partners have a more equal relationship where each party is contributing capital and expertise in different ways. And sometimes it can be more like a 90-10 or 95-5 split, where it would look more like a traditional LP setup. And sometimes people just say, oh yeah, we're going to JV on this, and they sketch out terms. And sometimes the clients haven't fully thought through exactly the mechanics of whether it's going to be a more manager operator driven fund or vehicle or a more equal venture. And sometimes the setup can also involve the capital looking more like debt or more like equity, but that gets a little more complicated as we go through. Michael, I'm going to hit the same points that you hit on yours. So for setup, the setup is, I would say, not necessarily fast or easy. The setup is usually a strict negotiation between you and the other party, showing exactly how the deal is going to look. That builds in the fundraising and the raising money are all built into that first upfront negotiation with the other party. So you have to obviously know who you're going to be going into business with and have the terms cut out. And as you're negotiating that deal, you're simultaneously raising the funds and planning for the deployment of them, usually for a specific asset. Sometimes you can do something like a joint venture formation agreement where you say, hey, here's a category of deals that we're going to look at. In the event we do decide to strike one of them, these are the bounds and the playground that we're going to play in and how the relationship's going to be formed. And sometimes parties can pre-negotiate what those terms will look like, or sometimes it's truly a one-off for a single asset. For management, that generally depends on the expertise of the parties and how much capital they're contributing. A lot of times, if it's the capital partner, if they're contributing a strong majority of the capital of the project, they want more control than you would see in a fund or a syndication. And that can take different forms, which I'm sure we'll talk about a little bit more in detail later. And waterfalls and distributions, again, that's just part of the general negotiation. Each partner might have expectations based on how much capital they're contributing or what services they're contributing to it.
Yeah, for sure. And I guess one point I probably should have mentioned that I didn't yet is when you're thinking about securities laws, funds and syndications are 100% securities. Like those are securities. You're dealing with the Securities Act, 506B, 506C stuff. If you've heard us harp on about that before, JVs are often not securities, and the reason is that a big part of why something may or may not be a security is whether you, as the person buying the security, are relying on the other party to do all the work and make all the decisions. So in a fund or syndication structure, that's generally true. in a JV where it's like, John knows how to do real estate. Well, I guess we have better examples than John on the call. Antonia and Adrian know how to do real estate development. And I'm just going to be a passive LP, then that's securities. But if it's a JV and it's like, well, I actually think I'm pretty good at this, and I'm going to have all sorts of major decision rights, like you can't do this without my permission, and you can't do this with my permission, and you can't do this without my permission, then it starts kind of getting to be not securities, because I'm not really relying on them for everything. I'm having some input. And so it's more of a business partnership than investing in a passive security. And so
that's a great point. And sometimes JVs can take the form of not even a single vehicle, but it might be like a merchant JV where a developer is going to have some, in the mind of someone, they say, hey, we're going to do a JV. They may have in their mind, oh, the developer is going to get some share of profits or some other benefit, and they'll consider that a JV, even though some people might not consider that a JV because it's not a single vehicle.
Yeah. So now let's hone in on a couple of terms. John mentioned some of them, and a lot of the terms are similar across funds, syndications, and JVs as far as like the universe of what we're talking about, but the exact outcomes might be different. So one thing that you negotiate in funds and SPVs and JVs are fund expenses, and so fund expenses are basically stuff that the fund pays for. And so in funds and syndications, that really means the LPs and the GP to the extent of the GP's commitment. And so this is something that can be negotiated. The short answer is that the fund pays for almost everything, except for things like the GP's salaries, their offices, things like the GP's laptop, GP level tax returns. That stuff is typically not paid for by the fund directly as a fund expense. And so when I mean fund expense, I mean you're using the fund credit card. You're sending money from the fund bank account. And so that's fund expenses. GP expenses, usually not. So how do you pay for that? Typically, that's what the management fee is for. And we'll talk about the management fee in a second. But the management fee is basically a recurring fee paid to the GP, technically the management company, but we'll just say GP. And that is used to pay for these GP expenses. I know maybe John, if you want to hop in for JVs, sometimes JVs, as John can explain, have provisions talking about like who bears pursuit costs and all sorts of things that aren't necessarily specifically contemplated as a negotiated point in funds and SPVs.
Yeah, so to the extent that the JV has a 95-5 or a 90-10 structure, you're likely to see something that looks similar to this fund expenses distribution here. Pursuit costs can, for example, in a JV formation agreement, be collective and netted out against investments that work or that don't work and carried forward through other deals. But if it's a single JV for one deal, the parties are negotiating that upfront in an active negotiation between usually the capital partner and the operating partner. But in some cases, I should have maybe mentioned this before, JVs aren't always a capital partner and an operating partner. Sometimes it'll be used by two competitors who are eyeing a target asset. Instead of competing with each other to bid up the price of the asset, they might go to each other, hey, let's JV on this project and mitigate the competition and reduce the entry costs to the overall project. And again, that'll change the entire way that the fund expenses look, because it might be shared equally in that case.
Yes. All right. Management fees in funds are for real estate development funds. It's typically something like this. It's typically 1.5 to 2% of committed capital. So basically the fund size for the first half of the fund's life. So if you have a $100 million fund, it's just $2 million a year for the first half of the fund's life. And then often the management fee base drops after once the second half of the fund's life begins. And so the percentage usually stays the same. It's usually 1.5 or 2 or whatever it was during the first half, but the base drops from fund size to actual capital deployed. So if you haven't deployed all the capital, your base is going to drop. But the more important thing even is once you start selling off assets, the management fee is going to drop. So over time, the management fee kind of goes, it's like flat, and then it goes kind of like at the end of the fund's life. And the idea is that, if this is your job and you're a fund manager, you're going to raise another fund at that point, and you'll get full management fees from that next fund. You might get some other fees, and these vary, like acquisition fees, disposition fees, blah, 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 blah. I wouldn't use all these fees. Sometimes clients want to use all these fees. I mean, it's up to you. I tend to try to get people to exercise moderation with fees, but sometimes I'm successful, sometimes I'm not. And then the last piece is like how are profits distributed? And I'll send this chart or this presentation around afterwards, because I'm not going to hit all of this in depth. But basically, the distribution waterfall explains when there are distributions, how are those profits distributed? And what I'm just going to focus on here is typically there's something called a preferred return. And the idea is that if there's money to distribute, in general, first LPs get their money back, then they get some sort of priority or preferred return. And this usually depends on asset class. So if you're doing development, usually there's a higher preferred return. Not always, but often there's a higher preferred return, because the idea is it's a little higher reward, higher risk sort of situation. And if you're doing something like buying, stabilized Class A stuff, then typically the preferred return will be lower, because you're expecting lower returns in general. Again, I'll send this around. There's things called GP catch-ups, which we don't need to get into here. If you have questions, you can let me know. The ultimate profit splits, the standard is 80-20. Some funds will do 70-30. Some funds get up to like 50-50 and all sorts of crazy stuff. We usually wag our finger at people when they start doing things like that, but our finger wagging, again, does not always work. But in general, 80-20, if you want to look legitimate at the institutional level, which is not everybody's goal, but if you want to look institutional, you want to do 80-20, unless you're doing a fund of funds, but that's kind of a different beast, in which case it should be even lower. I guess I'm just going to throw out a couple more just wild cards, and then I'll let John bring it home as far as the finish of the comparison with JVs. These are just some warning signs. I'm not going to go super in depth, but just things you don't want to accidentally screw up, which we see people accidentally screw up all the time. So one, if you have non-US investors in a real estate development fund or a syndication, make sure you have a really good tax lawyer. And make sure you're raising a decent amount of money, because the way to do it properly involves complicated setups, like offshore feeders and blockers and Cayman Islands and all that sort of stuff. So when you hear about people talking about weird stuff like the Cayman Islands funds, it's because they have non-US investors. So don't accidentally take non-US money without talking to a tax lawyer. The other piece is don't make your fund or syndication 25% or more retirement money. This is another landmine that we're not going to get into, but you might have a bunch of IRAs, that counts. Don't make your fund 25% or more IRA money unless you talk to an ERISA lawyer. And then finally, there's all sorts of laws that we're not going to get into here, called the Investment Advisors Act, Investment Company Act, which generally are not going to hamstring real estate development funds. But if you start investing in other people's funds or other people's deals or the passive interest in other people's JVs, you're going to subject yourself to a bunch more regulation. We have clients that do it. It's not a per se bad thing, but you just want to be careful about not subjecting yourself to more regulation that you weren't expecting. So with that, I'll turn it over to John.
Sure. So to the extent that the JV is looking more like a 95-5 or a 90-10 split, it's going to be more similar to the numbers and proportions and distributions and waterfalls that Michael presented. When it's a more equal relationship, you're sort of in the Wild West, and whatever the parties can negotiate is what the deal is going to be. There's a few nuances that pop up when you're dealing with a JV that you're not going to see in that world, though. One of them is control. A lot of times the capital partner will seek a little bit more control, especially if it's a more equal relationship. And sometimes the capital partner will want more consent over major decisions. The capital partner, if there's a more even split between the parties, may also want the right to call capital calls on themselves on the other partner as well. The control, if it's not going to be just a straight GP-LP style deal, the control can look a few different ways. You can have an affiliated third party as the manager. You can have the LLC. You can have a board of directors that's comprised of 3 members from one side, 2 of another, that can control decisions of the JV. And again, this is all based on the negotiation, the relative leverage of the parties and what they're trying to achieve. One thing that's also kind of unique in the JV is you have a lot of buyout provisions that are often negotiated. And these can be a little tricky because what you don't want to happen is you don't want a buyout to be triggered with a sort of fabricated or artificial deadlock. So you have to be careful about negotiating buyout provisions in a JV with another partner to make sure that you're not putting yourself in a position where you can get bought out of a deal that you want to stay into. That being said, one of the nice things about a JV is that if there's particular liquidity sensitivities, you can build the JV around each party's expectations or need for staying in the project for a long or short period of time. Another little nuance in JVs is when the parties, again, have a little more of an equal playing field. Sometimes the capital partner will want to make sure that there's provisions in affiliate contracts that in the event they have to take the project over, or in the event that the operating member is not doing what they need to do and not contributing their portion of the capital that they're expected to make, and the capital partner has to bring in control, that they have the ability to step in and do what is necessary with the affiliate contracts, because sometimes those affiliate contracts are with affiliates of the operating partner that they just had a problem with. So those are items that you're going to need to think about as you're putting together a JV agreement. Again, it's hard to summarize it overall because it really is a deal-by-deal negotiation between the parties in the JV.
All right. Thank you. Let's kick it to MADPROJECT.
Yeah, thank you. So we're just going to talk briefly about kind of what we're up to and why we like high-end condo and why we like New York.
Well, and I think actually, Adrian, before that, I think a good segue might be, and you can speak to this, but the reason we went with a fund versus a syndication, and I think that's probably a good start to condo economics and what you're going to talk about. So
Yeah, that's a good idea, good transition. So Antonia and I went with a fund. Why did we go with a fund? It's really specific to kind of the jurisdiction we're targeting, which is Manhattan, because deals there, development deals or otherwise, they tend to move quickly, and typically they have a closing period of 2 to 3 months. So in many places in the country, if you're doing a development deal, maybe you've identified a parcel of land, and there's a long process in terms of getting that land entitled, permitted, designed. The whole thing could take up to a year or more before the sponsor actually needs to bring cash to close. So that's lends itself actually very, very well to kind of the single asset SPV nature, where you can get a deal under contract, then you have a year to raise basically the capital to close on the land and fund construction, et cetera. In New York, it's very different because you don't have to do the entitlement process. Permitting process is straightforward. You already know from day one what you can do and what you can't do. So deals tend to close, and when they close all cash, you have to raise a lot of money in a short amount of time, which really lends itself to kind of the speed that Michael was alluding to earlier on why a fund is better for that specific market and why a fund can be a lot more competitive in pursuing deals and pursuing deals at the right price. So that's why we went with the fund structure. And then on the fee side, I think we're very in line with, like, we have an 8% pref and a 20% promote. So
Oops. It's a good thing you didn't have 50-50.
no,
Would have been really embarrassing.
That's not what we're going for. I think our
You must have good
at
lawyers.
the end of the day, we are 80-20, which falls more into kind of like the institutional pricing, and I think is definitely a little more attractive than versus kind of like the smaller shops. So that's on the fund and why we've gone the fund route. On what we're actually doing and why we like the product that we're targeting, which is kind of like high-end luxury condo. There's a couple of reasons. The first reason is that the buyer base of high-end luxury obviously is going to be like a high net worth or an ultra high net worth person. And we like selling products to them because they tend to have, well, for one, they have a lot more flexibility on whether they're going to pay in cash or pay in financing. They tend to only borrow money if it's a kind of a strategic decision to themselves. They don't need to go to mortgage. So if mortgage rates go up 100 basis points, it doesn't impact anyone's buying ability in this particular segment. And then the other thing is that because they have such higher discretionary income, much higher savings rates, much higher asset balances, much lower debt as a proportion of total net worth, they tend to be a lot more resilient in terms of their demand, and their demand is much more sticky, particularly in a kind of very high demand, high density market like Manhattan. So generally folks that are looking at homes, whether they're starter homes or maybe they're trading up, they're really dependent on mortgage rates. A lot of their down payments might be in the stock market. So if the stock market goes down 10%, they can't afford the same home that they otherwise could have. These things aren't really the same for the high net worth and ultra high net worth buyer. Like I said, so that we really like that aspect of it, because they do tend to show up. They want to be in a place, and they can show up all the time, regardless of what the stock market's doing or what the bond market's doing. And then why do we like condo, which is a for sale product? So the way it works is buy a site, you build a condo building, and then each individual buyer buys the condo unit from you. So you're not holding projects for 5 or 10 years and earning rental income. The strategy is to sell it. And why do we really like that? For one, condos don't trade, or they're not priced on a cap rate basis, because they don't have recurring income. So if cap rates, like they have done in the past several years, go from 5% to 7%, it doesn't actually impact the sellout values you can achieve in a condo. Conversely, if they go down from 7% to 5%, it doesn't impact the sellout values you can achieve. Really, the only three inputs are land value, construction costs, and then price per square foot that these kind of high net worth folks are willing to pay to live where they want to live. So very limited interest rate impact, because you're not financing, you're not taking a commercial loan to own a building for 5 or 10 years. You're not subject to refinance rate. You are borrowing money for the construction loan, but a typical construction loan is really only outstanding for a few years, and the full balance of that construction loan is really only outstanding for a few months. So you have much less sensitivity to interest rates, no sensitivity to cap rates. And the way that the market is set up now, pricing terms, like it's essentially equivalent to putting in cap rate terms of what you can do in Manhattan of building to an 8 cap and selling at a 6 cap. So you have a 33%, or the deals we like are between kind of 33% and 39 or even 40% development margin, meaning if you take the profit of the deal and divide it by all the costs associated with it, including the land and everything else, it's about 40%, which we think is really attractive and really healthy and provides a large margin of safety. Because what it means is that at the end of the day, sellout values could actually drop like 35% before equity loses money. So there's a lot of cushion in the deal. And in a place like Manhattan, with high stability of condo prices and actually some appreciation in the last year or so, we feel very, very good about kind of hitting our returns and protecting investor capital. So I'll turn over to Antonia to like why Manhattan specifically.
Yeah, so I mean, that's a good starting point. I think the economics, as we understand it, the way the market is right now, it does provide that 35-40% margin that we like to see, and therefore it's a good place to invest. And then it's a very specific segment within Manhattan that we're looking at. We're looking to deliver condos in the $2 to $5 million range, and what that does is it's basically the bottom of that luxury segment. And that allows us to have a much broader buyer base. So it's not only about the international buyer that's looking for capital preservation, but we also have about 2/3 of that buyer pool either locally or nationally in the US. And they're people who either want to have a pied-à-terre, or maybe they have a kid that goes to school in New York. And sort of that lower end, that $2 to $5 million range, those units tend to move really, really well in the market. So that's kind of what we are targeting. And then within that segment, we found that there's a gap, both for buyers and for investors. So for buyers, the gap in that market is usually those units are not very well designed. They're not necessarily properly amenitized. Like the amenities are too big, and then the HOA is too high. There's a ton of demand for specific neighborhoods, and so if generally the people who buy in those neighborhoods, they tend to be like younger, the neighborhoods that we're targeting. So they tend to be younger, and they might not necessarily want like the stuffy buildings that we see sort of in specific areas of Manhattan. So we don't want to compete with them. We want to target more to the younger audience. that generally doesn't get a lot of supply within that range in the more coveted neighborhood. So if we design more efficiently, if we amenitize buildings properly where they're not as expensive, we are able to hit higher price per square foot at smaller size units, and therefore the entry price for people who want to live there is more attainable. So that's one gap in the market that we've identified. And then for investors, similarly, typically developers that are working in Manhattan who are in the smaller project range, which is what we are targeting. And by smaller range, I mean, we're somewhere between 40,000 and 150,000 square feet. Generally, those smaller developers tend to not be of institutional quality. They raise money from a couple of their friends and maybe from a couple of acquaintances, but they're not necessarily managing the projects or reporting in a manner that is to the quality of the places where Adrian and I come from in our experience. So we feel like there is a great offering there for investors to say, hey, we're going to manage a project to the institutional quality that you'd expect a big developer in Manhattan. However, we're offering terms more similar to the smaller developers in the city, but you're actually going to get reports from us. You're actually going to get updates. You're going to know what's going on with the investment. Whereas normally with the smaller sort of fly by night kind of people in the city, that are working on these smaller projects, you might not necessarily get a very good service. So that's been a lot of the thesis around why we like Manhattan, why we like it now. I think more specifically, Manhattan right now, there was a change in legislation a few years ago regarding the abatements or tax abatements for affordable projects. And so what that did is those abatements ended, and it were replaced with very onerous requirements on affordability. And essentially what that did is the really big apartment developers, like for rent developers in the city, they eventually left, the national developers that were buying the city. So most of the development sites now in the city are more really going to be bought by more local people doing the smaller sort of projects and mostly targeting the condo because the condo market, because the rental market, again, without the abatement doesn't really work very well with the costs. So there are more development opportunities in general, and including the distressed debt and the office market, which we know has seen a little bit of a downturn after COVID. And there are a lot of these obsolete office buildings. There's just simply more development opportunities in the city, and then less of these really big national institutional players going for those sites. So we feel like from that perspective, there's just more to buy. Based on filings and like building department filings and just general market understanding, there's just a lot less new supply coming online, mostly on the tail end of that legislative change. So what that's going to do, obviously there's going to be a supply constraint, and we feel like traditionally there's been a little bit of it's better to rent in Manhattan than it is to buy in the last few years. We feel that as the rental supply, as there is less rental supply coming online, that value proposition is probably going to change, and it's going to be more attractive to actually own. So I think it further pushes our idea that condos in 5 years from now, which is probably how long it'll take to get the first project finished, by then there will definitely be more demand, especially when people begin to see that the value prop for renting is not as great as it used to be. And then that demand remains high, not only from the local sort of changes that we've seen in the market, but also from international buyers who are looking for value preservation of their capital. Like sometimes a lot of international buyers, they come from places where the government might not be so stable, and they're seeing a lot of devaluation to their currency. And at minimum, they want to know that they're not losing their money. And so traditionally, condos in New York don't really decrease in value very much. They're not astronomical. You're not gaining 25% on a like you're not seeing the value go up 25% in a year. But also, like during COVID, there was only a 6.5% decrease in the condo market, which is, and since then it's recovered. So it's a very strong place for people to invest their money. And again, like since we are targeting that $2 to $5 million range, it's also even more attainable for international buyers who maybe don't have $10 million, but they want to get $2 million out of their country, which is still a lot of money. They're able to do that in Manhattan. And when we look at projects that target that $2 to $5 million range, regardless of the specific buyer pool. And one thing to mention is that those buyers, and kind of to Adrian's earlier point, typically most of the buyers in that range, they tend to buy cash. So we got over 60% of the buyers in that segment are looking to buy in cash. And when we look at projects that target that range and that hit that range and that have very well designed units, they tend to sell out before you even have occupancy certificates. So we feel like overall, both from like a market perspective and from like a market segment perspective, and the fact that it's a for sale product, that's sort of what comprises our thesis, and how we kind of came up with really liking New York as much as we do. And then finally, we feel like the biggest risk in New York is really execution, is actually knowing how to get the team, get it designed properly, get it built properly, have a competitive bid and construction process. And I've spent about 10 years building a team that can do that. And we've done that successfully for other people for a long time. So the biggest risk for us is really, making sure we do it right, making sure that we build it successfully, and we do have the team for that. Those are all sort of the things that came together, and that's kind of how we built our thesis around New York and why we like it so much. So
Nice. Do you
the
guys
thing.
want to do questions if anybody has questions?
Yeah.
I have a couple minutes personally. I don't know.
Yeah, we do too. We're good.
Alfredo, how do we do questions? Does anybody have a question? I don't think they can talk unless Alfredo lets them. So if anybody has a question, let Alfredo know.
There's one question in
right.
the Q&A section. Do you have access to the?
Oh yes, I forgot about the Q&A section.
Yeah.
For other funds and how that may different. I think he left. I guess I don't know. I'll answer the question anyways. If we do this for other funds, does it differ specifically from the real estate asset class? So if you do funds for asset classes other than real estate, it kind of depends on the exact asset class. So for example, private equity funds are often pretty similar to real estate funds in that they'll have a preferred return and they'll have a management fee that looks very, very similar to a real estate fund. On the other hand, funds like venture don't have a preferred return and their management fee structure looks different. Funds like hedge funds have terms that are just like way different. They still like do a 2 and 20 model, but the way that it works is different. There's definitely differences between asset classes. A lot of the mechanics are the same. It really depends on the specifics though. The big things in addition to terms that change based on asset classes, and this also can apply within real estate as well, is how the fund is treated from a tax perspective and how the fund is treated from a regulatory perspective. So, that it really depends on the exact situation. But that's my answer to that. Does anybody else have any other questions? All right. Is that it? Very good. I guess we can tell people, we'll send some stuff around so you can find us on the internet if you like the internet and things like that. That's my really fancy outro. Antonia, Adrian, John, do you guys have anything else? If you want to form a fund, let us know. We form funds. We do stuff like that. Tell your friends.
Yeah.
You guys have anything better than that?
If you want to find us on the internet, we are on the internet, like Michael said.
John just asked if we have the contact email and number for the participants. Yeah, we'll send it all around. Alfredo will send around an email after this. It'll have like the 2 documents that I shared. It'll have contact email info for all of us. All righty. Well, thank you, everybody. Appreciate you making the time, and thanks, panelists for doing this with us.
Thank you,
Thank
guys.
you, guys.
Thank
All
you.
right,
Thanks, all.
thank you.
Thanks, Alfredo, for
Bye.
setting up.
Yeah, thanks, Alfredo.